Hi, everyone. I wanted to take you a little bit further out, zooming out on a graph that we used in a recent NewEdge Monday charts, and actually start to zoom in on the implications that it has for the economy and for our investing outlook. This is a graph of labor force participation in the United States since the 1950s. Labor force participation is just the percentage of Americans over the age of 16 who are working or actively looking for work. And the arc of this graph over the last 75 years contains a number of important stories. The most obvious one is the increase from the 1950s into the 2000s really reflects predominantly women moving into the labor force. You can also see as you kind of go through the history of this graph that recessions are bad for labor force participation. Workers often end up giving up looking for work, and that takes them out of the labor force, and they're often slow to return. Look at the 2008 recession. We didn't see any kind of a bounce from the decline in labor force participation during that period until 2015. So it was 7 years before there was really any kind of recovery in the percentage of people in the workforce. The biggest source of the decline since the peak in 2000 has been the movement of the very large baby boomer generational cohort into retirement. You have a lot more people over 65. Most of those people tend not to work. Many do. But as the percentage of your population over 65 increases, your labor force participation tends to decrease. We see this in economies like Japan as well. Periods when the economy is running hot, so the late 2010s, other periods in time, that tends to be when labor force participation can rise against the pull downward of demographics. And we had been seeing that in some of the last couple of years. So what's been happening to labor force participation in the 2020s is obviously it dropped like a stone during the pandemic, but it recovered most of that drop between 2021 and 2023. Part of that phenomenon was not just people who had left coming back. Many of the people who left the workforce in 2020 never came back, but we also had a very high rate of net migration into the US in those years. And foreign-born workers tend to participate in the labor force at higher rates than native-born workers, mainly because they're just younger as a cohort. That migration, whatever you think of it as a policy, that helped to raise the size of the labor force at a time when you had very low unemployment. And a lot of employers were reporting inability to find skilled labor, qualified applicants as their number one obstacle to expanding. So far in 2025, labor force participation has started to fall again. The size of the labor force, the absolute size in raw numbers, has also been stagnant, slightly down in the last couple of months. Employment has been falling among foreign-born workers with net migration levels now at zero or even negative. And hiring has slowed probably due to a combination of lack of available workers and also lower demand depending on what segment of the economy we're talking about. But labor force participation has started to fall faster as the demographic trend does what it does. It's continuing to pull down labor force participation as the population ages. And there's not much really now happening in the economy above trend growth. Again, overheating an economy is one thing that can bring labor force participation back up. We're not seeing that. Certainly, positive net migration, obviously, we're not seeing that at this point either. Those things had been holding the demographic forces at bay. They're not doing so now. Why we care about this? Labor force participation is one of the building blocks of GDP growth. The economy can only grow net of inflation because the population is increasing or because productivity is increasing. Productivity growth is still positive, as we found out in the last data release for the second quarter, but its rate of growth has fallen by about half in the past year, while population growth, as I mentioned earlier, has fallen to a halt. The implications here are that unemployment may be lower than it would have been otherwise. If you're shrinking population of available workers, you'll tend to see unemployment also fall, holding all else equal. Wage growth might also remain solid despite relatively weak hiring numbers. And as we look at the monthly jobs data, the potential growth rate in the economy being slower than it was in prior years means that the number of new jobs that we need to create each month to keep the unemployment rate steady is going to be lower, perhaps significantly lower. You may not need to do much better than the 73,000 or so new jobs that were created in July to keep the unemployment rate largely stable. Absent some kind of positive shock to productivity, possibly coming from AI innovations, we should expect trend growth in the US to be about 1.5% for the next few years. Doesn't mean it can't be higher than that. It could be lower than that as well, but that 1.5% is kind of your bogey for whether the economy is running too hot or too cold. Investments that perform well in higher growth environments might be challenged in this kind of an outlook, while very high growth companies that tend to benefit when growth itself is scarce might be benefiting from that overall scarcity and the fact that some of these companies are secularly higher growers, higher revenue growers, higher profit margins than others. And that's what we're seeing in the market so far in 2025. We'll have a lot more to say about this. Demographics, by their nature, change very slowly and are easy to predict, but there's always new wrinkles and new information along the way, and we'll be sure to pass that on to you. Thanks very much.